Welcome to our Deloitte webcast series, Year-End ASPE Update for Private Enterprises. My name is Glenda Rovine, and I'm a Senior Manager in National Accounting Services. In this segment, we will provide an overview of ASPE standards that are presently being developed or have recently been issued. Before we begin, a couple of housekeeping matters. If you would like a copy of the slides for reference, they're available for download on the same webpage on which you access this webcast. Comments on this webcast represent my personal views and don't constitute official interpretive guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. Deloitte will not be issuing professional development certificates for this webcast. We encourage you to check with your provincial institute or order regarding potential continuing professional development credit. We start with a look at what standards are effective for 2019. In fact, there are actually no standards that are effective for calendar 2019 year ends, so we jump ahead to the changes for 2020. It's worth noting that all of these changes can be applied early. The first two projects were completed in tandem with one another. Late in 2018, the Accounting Standards Board issued amendments to financial instruments. One set of changes impacted the classification of certain tax planning shares, and the other set of changes impacts financial instruments that are issued in a related party transaction. The application of both of these topics are complex, and therefore we have prepared separate webcasts that are available. So if you have either tax planning shares or financial instruments that are as a result of a related party transaction, we recommend you listen to those webcasts. During the year, two other narrow scope amendments were issued. The first of the narrow scope amendments to investments confirms that the previous amendments to the cost method for subsidiaries were also applicable to jointly controlled enterprises when such investments are accounted for using the cost method. The narrow scope amendments to income taxes simplifies the classification of future income taxes on the balance sheet when the future income tax method is applied. The amendments remove the requirement to present future income tax assets and future income tax liabilities as current and non-current. Instead, all future income tax assets or future income tax liabilities are presented as non-current. This will simplify the balance sheet presentation and is a treatment consistent with other frameworks. So let's take a look at what this looks like. Here we have an extract of the liability and equity section of a balance sheet for an ASPE enterprise that uses the future income tax method. Before the amendments are applied, the future income tax liability has been split between a current portion of $50,000 and the long-term portion of $33,000. After the amendments are applied, this split is no longer required, and instead the entire liability is presented as non-current. The same change would be made if there were future income tax assets. There is a new disclosure requirement related to future income tax balances. With the amendments, an enterprise is now required to disclose the amount of future income tax assets or liabilities for each type of temporary difference. The amendments are effective for fiscal years beginning on or after January 1st, 2020, but earlier application is permitted. The changes are to be applied retrospectively, so comparatives are restated. We are now going to look at changes to ASPE that are effective beyond 2020 or have not been finalized yet. The Accounting Standards Board has a number of active ASPE projects at various stages. First is the new standard on agriculture that was issued on November 1st, 2019, to address the diversity in practice from the lack of specific guidance for the agricultural industry. The new section is applicable for years beginning on or after January 1st, 2021, with earlier application permitted. We have a separate webcast that will be of interest to you if you are an agricultural producer. In addition, the board issued two exposure drafts during 2019. The revenue exposure draft was issued early in the year to address stakeholders' concerns about the lack of guidance on accounting for revenue in Section 3400 of ASPE. The board recently finalized the amendments and confirmed an effective date of January 1st, 2021. If you are interested in learning more about the amendments, please listen to our separate webcast on the subject. An exposure draft was recently issued with respect to employee future benefit and the impact of current regulations when a funding valuation is used. And we're going to look at that in more detail shortly. The other two projects are a project to review financial statement concepts, including aspects such as definitions of assets and liabilities. The board has also started a research project to better understand the different types of related party combinations undertaken by private enterprises and not-for-profit organizations, and to understand the accounting challenges with such transactions. It's also worth noting that during 2019, the board provided an update about its decision not to undertake a project on hedge accounting. The board noted that during their outreach, private enterprises and the users of their financial statements appear to have become accustomed to using fair value to measure derivatives, and it seems that the current guidance in Section 3856 is in fact meeting users' needs. So let's take a look at the exposure draft on employee future benefits in a little more detail. First, let's go over the current accounting requirements for defined benefit plans with respect to how enterprises are valuing their defined benefit obligation. Some defined benefit plans have a funding valuation requirement. For these plans, the current standard provides relief from obtaining a separate accounting valuation by giving these enterprises a choice to use either a funding valuation or a separate accounting valuation when valuing their defined benefit obligations. The accounting policy choice is also available for certain defined benefit plans that do not have a funding requirement when specific criteria are met. This simplification was intended to provide relief from having to prepare a separate accounting valuation for such plans. However, this policy choice has led to diversity in practice. The amendments proposed address this diversity by restricting the types of plans that can apply the funding valuation and by clarifying the components of a funding valuation that should be included in the measurement of the defined benefit obligation. This diagram summarizes the proposed amendments. As you can see, if a defined benefit plan has a funding valuation requirement, then there is still an accounting policy choice to use either an accounting valuation or a funding valuation. If we follow the right branch of the diagram, you'll see that if an enterprise chooses the accounting valuation, then there will be no impact from the amendments. If the enterprise chooses a funding valuation, then there is amended guidance to clarify what must be included in the measurement of the defined benefit obligation. Specifically, the obligation must include all the amounts required to be funded in accordance with all legislative, regulatory, and contractual requirements. It must include the aggregate of all underlying components of the legislation. And so this would include examples such as in Ontario, the provision for adverse deviation, and in Quebec, the stabilization provision. For a DB plan that does not have a funding valuation requirement, it would fall under the left branch of the diagram, and there's no longer an accounting policy choice. The enterprise would have to measure the defined benefit obligation using an accounting valuation. If they had previously used a funding valuation, then they must change to the accounting valuation, but there is some transition relief available. So let's take a look at that. The amendments are effective January 1st, 2021, and enterprises may choose to early adopt. There is transition relief that if you have a completed funding valuation available as at the date of transition, you do not need to obtain a new funding valuation on transition. The impact, if any, would be recorded in opening retained earnings on the date of transition or the earliest prior period, depending on when the most recent funding valuation is available. The exception is plans without a completed funding valuation on the date of adoption. For these plans, the enterprise would apply the amendments prospectively, with the impact of adoption recorded in net income in the year that the funding valuation is completed. So in this case, there would be no adjustment to retained earnings. Let's look at a couple of examples to illustrate the transition provisions. In example 1, the most recently completed valuation was available on April 30th, 2019, and the earliest prior period is January 1st, 2020. In this case, the cumulative adjustment is recognized in opening retained earnings at January 1st, 2020. In example 2, the most recently completed valuation was available on April 30th, 2020, which is after the date of the earliest prior period. Therefore, the cumulative adjustment is recorded in opening retained earnings at January 2021, the date of transition. So lastly, let's take a look at the transition for those defined benefit plans that have no funding valuation requirement and therefore need to change to an accounting valuation on transition. For these plans, the amendments would be applied on the date of transition, so January 1st, 2021, if not early adopting, and the impact of adoption would be recorded as a cumulative adjustment to opening retained earnings on the transition date. There is no restatement of comparative periods. Before we close our session on ASPE updates, we wanted to remind you of the many resources that are available to support you in learning about the topics that impact your organization. We continue to highlight the websites of FRAS Canada and CPA Canada, which both have a number of resources to help you navigate the changes. There are a number of podcasts and webinars that are upcoming, or if they've previously occurred, are available on demand. We hope that you found this update informative, and we invite you to listen to the other webcasts in our series for more information on the topics that are relevant to you. Thank you.